One is what is defined as the reporting entity, and secondly, what does a CAFR contain? I think most of you know the answer to the first question already. I mean, to the second question already. So let me ask the first question. And interestingly enough, some people were a little confused at the start when we started with this course. When you look at the state of New Jersey's financial statement, what entities does it contain? It contains the state. What else? Now, some of you might think it should contain all the towns and municipalities and counties and others, but it does not. It contains the component unit known as Rutgers, yes, UMD, previously UMD&J for the old CAFR, New Jersey Turnpike Authority, these are authorities. Now, this might not seem important to you, but when you look at the CAFR and you look at the very first footnote of the CAFR, the very first thing it addresses is, who does this report represent? What is the reporting entity? And that's what we'll discuss today. Might seem simple enough, but we'll talk about that, okay? As to what that reporting entity is, and as somebody said, you know, what those component units are, which should be included within the reporting entity. Next, we'll take a look at the CAFR and each pieces of it. And as I said, we won't spend too much time on it because you've already gone through a lot of it already. But the last piece, which is how do you reconcile the government funds financial statement to the government wide financial statement, is something which would be interesting to look at. So that's the kind of the agenda, those two major areas. So what is the objective, or under GASB concept statement number 1? There are two primary objectives of government financial reporting. One is to assess accountability, and other is to allow us to make these types of decisions. That's under GASB concept statement number 1. And what are the characteristics of that information? It's just not relevant to the government itself, but it's to all entities. Okay, it has to be understandable, reliable, relevant, timeliness, consistency, and comparability. Where do you think governments lack? See if you can get this answer. Among all of these, what are some of the areas from your experience right now looking at government financial statement? Timeliness. That's a good point, because timeliness is, you see governments not issuing their financial report till 6 months after the year is over. And under GASB, this is a big issue. And of course, some of you, I thought, would also say understandability. But you didn't want to say that because you're in this class.
What about the reliability when we hear about government officials pocketing money?
Yes, that's right. Reliability is as to how reliable could it be if you hear about corruption and about all of this. But fortunately, we have the auditors who should be checking up on that. But you're right, to the layperson, that is a big question. So timeliness is a very, very important issue. You know, if I asked you, yes, you're right, if that were in the test. See, he's getting right, zeroing in right to what it should be. And he's not shy about it. Okay, concept of financial reporting. Now, this is just basically review, and these are the elements, the 7 elements, and hopefully you know what each one of these are. And what's the important thing about these elements? Well, they have to be measurable, because without being measurable, you cannot include them in the financial statements themselves. So these are defined under GASB concept statement number 4, which talks about these here. So we have 7 elements, both on a modified accrual basis and on an accrual basis. Now we come to really what we are here for in this chapter, which is the component unit itself, or the reporting unit entity itself. So when you open up the statement of net position. Okay? Actually, let's see if we can look at one of them. Here we go. Sorry, what I'm going to do is just go back to this for a minute. Okay. One of the first things people look at when they open the notes to the financial statement is this concept of financial reporting entity. And it's interesting, when you read this, this is exactly what's in your textbook. So let's define this. You open up the state of New Jersey's CAFR. What's the first question you want to understand? What does that CAFR represent the activity for? We know it's state of New Jersey, but is it state of New Jersey plus all authorities, plus all municipalities, plus all counties? What does it represent? So for readers of financial statements, it's very important for them to know what do the financial statements represent the activity of, okay? And in this case, what I want to tell you is it represents the activity of the state, and it represents the activities of the following colleges and universities. Notice they are all state institutions. These are the authorities of the state that are represented within the New Jersey CAFR. So what did we see? State of New Jersey, and what else? Educational institutions and authorities, right? Any towns? No. Any counties? No. Most of us are people who are not familiar with this subject assume that the state of New Jersey's financial report contains all its municipalities. No. Okay? And this is where we come back to the discussion of the reporting entity itself. Okay? And let me give you the definition of what the reporting entity itself is. It consists of the primary government, in which case, what is it? State of New Jersey, and all component units for which the primary government is financially accountable for. What are those? Those are the component units. They're reported by discrete, separate column presentation, and I'll talk about blending for a moment. Okay? So let's go back to the definition of primary government. A primary government can be a state, can be a county, can be a municipality or a city, or can be a special purpose government. 4 different things a primary government can be. Why did I tell you this? Because if you are a primary government, you cannot be a component unit of something else, a special purpose government. Okay? Again, it's a little confusing. But a primary government could be the state, could be the counties, could be cities, could be special purpose governments. And what we learned is that primary governments issue their own CAFR. So a city would do what? Issue its own CAFR. A county might issue its own CAFR. Please don't take this for New Jersey. New Jersey is the odd state out, okay? All right? So these are your primary governments. What are component units? They are authorities of the state and others. Let's see if we... Okay, let's go back to the primary government for a moment, and then I'll come back, because I want you to really get this definition. The question is, if the state of New Jersey issues a financial report, what should it contain? It should contain the state of New Jersey and anyone who satisfies this criteria, which is if another organization, for instance, I worked at the Meadowlands, the state had the authority to appoint the board. When you can appoint the board of an entity, do you have control over the board? Can you impose your will on that? Yes. Does the state have the ability to appoint the council at city or county level? No, because they're done what? They're appointed by the constituents within the citizens within that. Yeah.
What if the municipality goes bankrupt?
Well, then it's a different thing where the state takes over. Okay, and in our case, New Jersey, as I'll come back to you, we deal with it a little different, but it happened in the city of Camden, where they were in such trouble, and the state kept on telling them, you need to do this, that. Mayor said, I don't care, I'm not going to do it. They said, no, you have to do it. They said, I don't care. Let the city go bankrupt. I don't care. This is my city, and you're not going to interfere with the way I run the city. So guess what the state did? They went into court, and they literally took over the city. They threw the mayor out. They became the boss. And that was the end for the city of Camden. Okay? So in some cases, that does happen, where the state has the power to financially take it over, but also in other ways take control over that. So again, these are the tests. If you can appoint the board, obviously, right? Or you can impose your will through that. And the second is that where you can potentially provide specific financial benefits or impose a financial burden on the other organization. What does this mean? So you can appoint the board. For instance, if you have an entity, just think about this. If you have an entity, if it goes under, something bad happens to it. If the state has to come and take that over, or they have responsibility, their financial statement has to be included in the state. So for instance, see all those Rutgers and everybody else, the authorities listed? It basically says if something happens, does state have responsibility? Eventually, yes. Now, Rutgers is kind of interesting because, the state doesn't appoint the board for Rutgers. The state has a state representative, but the Board of Regents are not appointed by the state. There are two different boards, so it's a little different. But these are the conditions that tell you whether to include an entity within a primary government. You can appoint the board, or there is some financial benefit or burden that accrues from that relationship. If you meet those two tests, whatever that entity is, you must include that in the primary government's CAFR. And look at this. Even if it does not appoint a majority, if the primary government is financially accountable for another organization, if the other organization is fiscally dependent, the other organization can provide specific benefits or impose. Remember the case of Rutgers? Even though you might not appoint the board, but if it meets those two tests, you have to include their financial statements as part of the CAFR. You want to see if they in fact do that? Let's go back. There we go. There's the component units within the state of New Jersey CAFR. Rutgers State University is included as a component unit of the state of New Jersey, and therefore included within the state of New Jersey's financial report. Let's look at Rutgers. I always like to see net assets. How do they look? How does Rutgers look? That's the last column on the right. Do they look okay? All right. I won't say anything more. Okay. All right. Who else is included? UMDNJ, and other non-major component units, and they all come out to that. Do you see that? So what do you do? Again, those tests, right? Some financial burden or financial interest, and what? Ability to have control, right? And even if you don't have control, if that meets the test. All right. I know this is kind of a dry topic, but it is, you do need to understand this to be able to know what should be included. Because if you are the accountant for a an entity, the question will always come to you, all right, I work for this town, the library. Should I include that in my CAFR? All right, library board. Who appoints the library board? The mayor does that, so we have control. Who gives the funding? Who provides? We do. You know what? They should be included. So it's very important to know that so you'll know what to include in the CAFR. Okay. And this is the definition of financial benefit or financial burden. If you're entitled to the organizational resources, bless you, is legally obligated to finance the organization's deficit or is legally obligated in some manner for the organization's debt. And remember, this is even if the board was independently appointed. All right, so let's just do a quick review of this. What do we mean by primary government? There are, remember, city, special purpose, county, or state, right? Just think of it. If I didn't have city in it, what would happen? It would have to go into some other primary government, in which case it would be what? State of New Jersey, because it's not a primary government by itself, right? Again, remember, it's important to know what the primary government is, because then you know what the top level reporting entity is. Okay. And what are the two tests? The appointment or control of the board and the financial burden or benefit test. And can you still have to include that in the primary government? Yes, even if there was a financial burden or benefit. Okay, and I gave you the example of Rutgers. Right? So it's not that difficult, but I wanted to tell you this because there is a nice little chart somewhere in the book which goes through, and this is what I'd like you to do on your own. I want you to take a look at this chart on page, actually, you know what, we can take a look at it now. On page 359. Let me just go back and I'll show you. This is the chart, okay? So what they are trying to do is they're trying to figure out if a component unit should be included or not included in the CAFR. Look at the question. Is PCU legally separate? And I'll just take the case of the Meadowlands. Is it separate? Yes, it's separate from the state of New Jersey. Does the PG, in which case PG is what? The state, appoint the voting majority of the board? Yes. Is there a financial benefit or burden test, or is it able to impose the will? Yes. Does the CU meet the criteria for blended presentation? And I'll get, basically what this means is you can show a component unit in its own column, or you can add it to the primary government, and there's no trace. You just added two things together. That's called blending. Why would you do that? You do that only for entities which do business only with primary government. They don't do business with the world outside. It's all internal, and their activities are so intertwined with the primary government that you don't separate them. So there is a way to present their information is either blend it or include it all in one column, or have it separate in discrete columns as a component unit. So this is what it says. And in this case, if it's not, then you show discrete presentation. Does everyone understand the meaning of the word discrete? Yes. This is on page 359. Okay. Let's go back. And what I'm going to do is, just so, because I think it would be a lot easier for you to see this. This is the statement of net assets. Notice the headings: governmental, business type, and what? And what were those component units? The one that we just looked at, right? Now, some states, if you looked at the CAFR, listed the component units separately on this first page. Some do, right? You probably saw some states did list it separately. But here, what did we do? We just combined it. So the next question you might have is, which ones do I show as major component units, and which ones do I show as non-major? Most people tend to use that major fund test to arrive at that, okay? But you can choose to show a component unit as major if you decided to. They have much more leeway. But the same test that we use for major fund is applied for major component units. So what does the state report contain? The state's operation and what? Its component units presented in a discrete manner. Discrete meaning each one has its own column, except if it's non-major, in which case it's all put together. Is everybody with me? Okay. All right, let's go back to the financial reports themselves. So again, you need to know the concept of the financial reporting entity. And as I said to you, it's interesting because when you look at the state of New Jersey, it seems as if it's right out of your textbook, this footnote. The state is financially accountable. It appoints a voting majority. State may be financially if it's fiscally dependent. Same things we just talked about. That's from the footnote number 1 of the state's financial statement. Remember, components units can be either discretely presented or blended. Okay? Any questions so far? All right, now we come back to the financial reports. The next discussion, I'm going to go through this quickly because you know most of this already. What are the major sections of the CAFR? Introductory, financial, statistical. Okay? And you should know those by now, but basically it talks about the need for having this. By the way, I don't know if I ever mentioned this to you, but right now Rutgers is involved with the GASB. We have several PhD students and several faculty. I'm involved in this, in taking the CAFRs of all the states. And what we're actually doing is we're trying to come up with a way through our information systems area to extract data and tag. Does anyone know XBRL, which is the Extensible Business Reporting Language, and be able to tag that data and be able to store that data and do that analysis. It's the only one of its kind. There are only 2 universities in the country working on this, and Rutgers has taken the lead with them and with the Governmental Accounting Standards Board. And so I'm telling you, as we look at this, this is real stuff. This is what we are taking a look at, where, in fact, I'm meeting with the PhD students to go over, and some of them, this might be their dissertation on how to extract and manipulate and work with this data. And, because government financial reporting is much further behind that corporate financial reporting is. Corporations are required to do their filings through XBRL if they reach a certain size. Governments don't. It's all in PDF. And can you imagine looking for information in those PDF reports? As you saw, it's not the easiest thing. But this also talks about interim financial reports. The reason I mentioned that to you is if anyone is interested over the summer on working on this, let me know. I know you'll all be out there job hunting, or if you're probably starting off, but this is one of the big projects that we hope to get going. Okay, so these are the sections of the CAFR itself. And the introductory section, as you what I want to do is just concentrate on one thing, which is the letter of transmittal. The letter of transmittal is not normally audited by the independent audit folks. You can't, of course, say things which are wrong, but it doesn't go through the same scrutiny, for instance, as the rest of the financial report goes, okay? And so some entities use the letter of transmittal as their PR. And for those of you who've read this, you probably noticed that. Say good things about, oh, this is great, and then you go to the report and it looks awful. But, that's what the letter of, but it shouldn't be that way. It's usually signed by the CFO and the CEO. The other thing about it, and the book doesn't talk about it, is Sarbanes-Oxley is now present in governments. So when I signed the Meadowlands report, and if I knew that there was something not right with that report, or something that was false, it's considered a crime and a misdemeanor when you sign. So for, when that question was raised, government CFOs cannot claim ignorance. If they do something not right and they sign off on the report saying this is good, it doesn't matter if the auditors catches you or not, but if they find that you purposely misstated something, you're going to go to jail. And that's the Sarbanes-Oxley for governments. And I mentioned that to you because the letter of transmittal is one of the areas where people might get a little, carried away. Okay. There's also, you notice the GFOA letter, Government Finance Officers Association letter. It's called the GFOA Award of Excellence in Financial Reporting. It's given to those entities which do their financial reports really well. Okay? But I want you to listen to something. I said do really well as opposed to those who are doing really well. Do you see the difference? Those who prepare the report really nicely as opposed to those who are actually doing well financially. So what happens is a lot of people look at that letter and they say, wow, they got a certificate. That means things must be really great. It has nothing to do with it. All it does is it tells you that the report is prepared as per GASB standards and everything else. Okay. Now the auditor's report and the MBA, now we come to the really heart of the, and we'll talk about the auditor's report in the next class when we take a look at Chapter 11. What you'll notice is some of you noticed that the report was issued by the state auditor, which is a legislatively appointed auditor such as New Jersey, or by an independent auditing firm such as KPMG or some other firm who have Deloitte, who have major government practices. And it's interesting. I just said Deloitte, and I thought of. I was at a meeting of the National State Association of Controllers. While I was there, the partner for Deloitte in the Midwest area came up and said, we're trying to find some people in government accounting. We can't find any. If you know of any graduates, this is in our program, in governmental accounting, send them to us. I said, well, that most of them, 90% of them are employed. I mentioned that to you because I know most of you probably are going to go into tax and audit and other areas, but there is something to be said about being in the government area. And most people don't go into it because it's not exciting. But one of the side benefits of working on a government client is, are your hours going to be 9 to 9 if you work for a government client? Or 8 to 7 to 9? No. You're going to keep pretty much, and the auditors don't like to see that, obviously. But, I wanted to mention that to you because there is, for those of you who might be interested, there there could be a place even in the audit area and also in the consulting area. Now the MD&A, which is Management Discussion and Analysis, is really the area that most people turn to. They turn to that because it describes in layman terms what? Very quickly, it describes to you the government's financial position. It describes to you how things have changed from the previous year. It describes to you factors that have occurred or things that might have led to changes in operation. And it presents that all in summary format. And the MD&A is usually the one most people go to really get the details. It has information on capital assets, on debt. All of that is in the MD&A itself. Basic financial statements. What are the basic financial statements? Your government-wide and your fund financial statements. RSI, this is the budgetary comparison schedule, and pension schedules, and combining an individual fund financial statements, which some of you saw already, which was for non-major funds. What I'd like you to do is understand what each of these contain. Understand what each one of these contains. I can talk about it, but it's important that you know what they contain. So for instance, the basic financial statements contain statements on how many different types of funds. Governmental funds, proprietary funds, and fiduciary funds. How many statements altogether? 3. Altogether. I think it's 9. Okay? What are the titles of those statements? You should know those. Do you see what I mean? You need to be able to understand that. That's the financial section. The statistical section has these 5 separate categories. And actually, this will lead us to our discussion for our next topic, which is analysis of government financial condition. So what's financial trend information, by the way? Things like fund balance, right? How many years of history, by the way, here? 10 years. And we'll take a look at these more in depth when we go to chapter 11. But these are the 5 categories of information that's found. What's operating information, by the way? Things like number of employees, capital assets, what shape are they in, your service and efforts accomplishments, your performance analysis. So this is the general purpose external financial report. This is where we started off from. And does everyone know the difference between the minimum requirements as opposed to the CAFR? Minimum requirements are all these, and the CAFR has what? Parts of the introductory and statistical section, which the minimum requirement does not. These are the statements, I think. Let's see if I got the number right. Okay, statement of net position, everybody know that, right? Statement of activities, these are the 2 government-wide statements. What are the fund financial statements? We'll go to the next one, and notes to the financial statements. So that's the basic financial statement package. And I'll go through this because I want to go talk about several other things. Balance sheet and statement of revenues, expenditures, and changes in fund balance. That's for the fund financial statements. Balance sheet and the statement of revenue, expenditures, and changes in fund balance with reconciliation, which we'll talk about. Statement of net position. This is for the proprietary fund. Statement of revenue, expenses. You should know the titles of these statements for each one of these. And finally, the fiduciary funds. So that makes it altogether 9 statements that you have. And this is just as a review: government-wide financial statements, entity-wide, long-term focus on operational accountability. And what do they contain? Business type and governmental. Any fiduciary? You know, I'm going to ask you that again. I love that question. Any fiduciary? No. All right? Expect a 99.999% response on that. Okay? No fiduciary. Okay? And what's the basis of accounting? Accrual? What measurement focus? Economic resources? Right? Okay, you got the gist of it. Now, what I want to do is, if you ever have the fortune of actually doing these statements, you will be, it's a little involved, but I'm going to try to keep this very simple. There isn't one accounting package out there, SAP, Oracle, where you can push a button and say, produce statements on modified accrual basis, and push another button which says, produce statements on accrual basis. You've got to figure this out yourself. So this is what happens. What is, if you were the CFO of a governmental organization, you had a choice between 2 bases of accounting, modified as opposed to full accrual, which one would you pick? Practically. If you have budgets and you have others, you've got to use modified accrual, because that's what budgetary accounts, remember we talked about budgetary accounts? So now you pick one or the other. Let's assume you pick the modified accrual. How do you get to the accrual basis now? Well, what we do actually is, in practice, we produce a trial balance on the modified accrual basis. And then we take these steps to convert it into full accrual basis using a spreadsheet package, using our own spreadsheet program. Very involved, takes a lot of work, and nobody wants to do it. But that's the only way to produce accrual statements. Isn't that surprising? Aren't you surprised that there isn't a software package which just takes this and doesn't do it? Because of some of the things which we'll talk about. Okay? Let's talk about the first thing. Modified accrual basis. Do you record depreciation in modified accrual basis? If you had to prepare on an accrual basis, what would you have to do? Adjusting entries to record what? Annual depreciation. How about interest? Do you record interest the same way under accrual and modified accrual? So if you had to record it, if you had to prepare government-wide statements, what would you have to do? Do an interest accrual, okay? Receivable or payable, mostly in our case payable, okay? What else do? You close all the program and general revenue expense, and you reclassify, and I'll get into this in a moment or so. And let me show you. I'm trying to keep things as easy as possible here, but let's go to page 368. This was a trial balance that was taken. In order to close accounts, why are we debiting these accounts, program revenues, all these revenue accounts? Because to close them, what do you have to do to a revenue account? Zero it out. And what do you do to expense accounts? And what do you do with the difference? Net position unrestricted, right? Is that good or bad, having a debit like that? Net position. Were our expenses greater than our revenues? Yes, right? Do you understand the basic entry, the closing entry, right? Okay. Now the next thing is, remember when we looked at the government-wide statement, the statement of net position had how many different components? It had 3. Somebody said 3. What was it? Amount invested in what? Capital assets, net of debt, restricted and unrestricted. Now what has to happen, and this is, try to see if you can follow this. When you are dealing with a corporate entity, there's only one line, retained earnings. You just throw it in there. With governments, you have what? These 3 lines. It's like a pie with 3 slices. Every year, you have to readjust the size of each slice. Every year, you have to readjust the size of each slice of the pie. Why do you have to do that? Let me explain. If your amount invested in capital assets was, net position, net investment in capital asset last year was $1 million. You just bought another $1 million worth of assets. What's going to happen to that number? The amount invested in capital assets. It's going to go up from $1 million to $2 million. So what happens to the slice? It gets bigger, right? What happens to the restrictions? If you have debt service funds which were $500,000 last year, but now you only need $250,000. What do you have to do? Adjust the slice down from $500,000 to $250,000. If you get those 2 parts, you automatically get the third part. If you know the size of the pie and you know 2 slices, you know what the third slice is. And this is what's happening here. Here, what they're doing is they are transferring amount from, maybe I should show you this at the top so you could you guys, can you read this at the top here, or? Just bear with me, as I said, for a minute. Just try to see if you can get through this, okay? Net position, net investment in capital asset. What happens when you debit a equity account? Are you reducing it or increasing it? Good. And so what are we doing? We are reducing this slice by this and increasing what? The unrestricted. Because we have to adjust the unrestricted each time, right? What are we doing here? Net restricted for debt service. Are we increasing it or decreasing it? We're increasing it. Do you see what we're doing? We're adjusting the slice each time. Take a look at this example. Once again, I'll repeat this. At the end of the year, you need to determine what the correct amount is in your net position, amount invested in capital assets, net position which is restricted, and net position which is unrestricted. At the end of each year, you have to do that. And this journal entry on page 369 shows you how it happens. Anytime you change the size of a slice, you have to change the size of the unrestricted, because that's the one which is left over. So if you increase amount invested in capital assets, you have to do what? Decrease the amount in unrestricted, and vice versa. I hope you got that, because it's a little, it's not easy. Believe me, I understand that, but it's not impossible either. Okay? All I'm telling you is that when you close your program revenues and program expenses, there's something left over, right? That gets added to the pie. And then after that, you slice it based on the facts. Okay. And this is what happens in practice, by the way. So it's not something that's shown here only. And this is what we're talking, entries to reclassify as necessary, these items. Let's talk about the fund financial statements. Sorry. They use what? Modified accrual basis. Now, let me tell you this because some people might get confused with this. Unfortunately, it's the terminology. That's what gets people, you know. Fund financial statements. When you talk about fund financial statements, most people think of governmental funds. Governmental fund financial statements, which use what? Modified accrual basis. Unfortunately, there's something called proprietary fund financial statements and fiduciary fund financial statements. Do they follow modified accrual basis? No. They follow what? Accrual basis. Don't get confused with the word fund financial statements, because it could mean what? Both modified as well as full accrual. If I said to you governmental fund financial statements, then it's what? Modified accrual basis. Okay, so there was a couple of years ago, the Governmental Accounting Standards Board issued a new standard, GASB statement number 54, which changed the way you show fund balance. Now I want you to just think about this. In the government-wide financial statement, what's the equity section called? Net position, right? In the government-wide financial statements, what's the equity section called? Net position, right? In the fund financial statements, which is the balance sheet, what is the equity called? Fund balance. You see the difference? One calls it what? Net position, and the other one calls it what? Fund balance. Net position was divided into three, right? Parts, which we just talked about. What's the fund balance divided into? These 5 parts. Get it? The net position was divided into 3. Fund balance is divided into 5, and I'll explain that to you. There's 1, and then there are 4 within the second category. So what's non-spendable? And this was one of the questions I had asked you. What's the fund balance? Assets minus liabilities. What does government use? Flow of financial resources. Very much like cash. So assume for a moment, if everything was cash, assets minus liability tells you what? How much cash you have left, right? Or near cash, right? If you have inventories under your assets, now you've got an issue. Because you say fund balance, that's going to show the amount of inventories because it's asset inventory is included in assets. So what I'm saying to you is GASB came up with 2 different categories of fund balance. One that you can spend and one that you normally don't spend. Can you spend inventory fund balance? No. So it's called what? Non-spendable. So if you have inventories of $10,000 on your balance sheet, what's going to be your fund balance non-spendable on the balance sheet? Exactly the same number, because you can't spend it, right? If you have, again, let me give you an example. If you have $10,000 in your inventory account on the balance sheet, what's going to be your non-spendable fund balance? Exactly 10,000. Because it's assets minus liability equals fund balance. So that's why we call that non-spendable. Now let's take a look at spendable. These are the categories. Now, many years ago, I can remember, before things got really complicated, we used to have a great time at the end of the year. The question was, how do you hide money? Why do you want to hide money? Because you don't want folks to say they've got all that money, have them spend it. You wanted to keep what? Monies in reserves for contingency, not to give yourself bonuses. But what was it? It was to allow you to meet unforeseen expenses, okay? So GASB thought leaving it to CFOs to figure out what was restricted, what was unrestricted, wasn't going to work. Because there are some people who were very loose, and there are some people who were very careful. And the auditors were pulling their hair out because they didn't know what to do. So GASB came up with this statement number 54, which basically said the following. You have 4 categories of spendable fund balance. And we'll start off with the first one, which is restricted. Restricted fund balance is a fund balance which is constitutionally or by legislation restricted, meaning it's designated for a purpose and it's done outside your organization. It's written in law. It's through some outside law. You have no question about it. Tells you $1 million of your fund balance is for that. That's what it's for. And you have to show it as restricted. The next one I see is committed. This is now based on the highest level of decision making. What is the highest level of decision making for a government? The board, right? The board of directors or board of commissioners. If they say, you know what, it's to be used for this purpose. We want to do this expansion next year of this building, and you're going to dedicate this, and we're going to pass a resolution dedicating it for this amount. It becomes what? Committed. See how it's come down from outside to now inside. How about our CFO? The CFO says, okay, I've got my share too. What I like to do is I like to save this money for maybe upgrading my computer system. That's now at a lower level, right? But it's still a CFO or a financial manager, right? From the board, you've come down to what? The CFO or financial manager. That's called assigned. And anything that's left over is unassigned. Those are the 4 levels. And you need to know that. Everybody got that? And that's what that is. I have to tell you one thing, which is, and let me see if you get this. Yeah.
So the difference between committed and assigned?
Yeah, the committed is when it's done at the organization's highest level, which would be the board of directors or board of commissioners. Not people working in the organization, but those who basically are responsible for running it, okay? And the assigned are those people who are senior finance managers who can make that decision. And unassigned is everyone else, or no restriction, okay? Now let me ask you a question. What was capital projects fund used for? Was for construction of large assets, right? Construction projects. They also have a fund balance. What do you think? Do you think you can ever have an unassigned fund balance in a capital project fund? Just think about it, just logically. Can you have it? And you're right. How about the fund balance in a debt service fund? Can you ever have unassigned fund balance in a debt service fund? No, because it's used for what? For debt service. So if you have some money left over, it's still going to be used for debt service. So what I wanted to tell you was unassigned fund balance can be found in special revenue fund and general fund, but not in capital projects fund, or debt service fund. So far, so good, I guess. Okay, we just talked about that. Now let's take a look at the next part. And this is on page 376. But before I go, let me explain this to you. What are the two operating statements? Statement of activity and statement of revenue, expenditures, and changes in fund balance. Do they have the same numbers? No. Statement of activity is on what? Accrual basis, and statement of revenue expenditures is what? As a reader, would you like to be able to reconcile those two statements? Yes. How about the balance sheet and the statement of net position? Do they show exactly the same numbers? No. Would you like to reconcile them? Yes. How many reconciliations do you have to do? 2. Between the government-wide and the governmental fund statements. So let me ask you this question, and I'm going to have you do this in your head. When you spend money on a capital assets in governmental fund, do you capitalize it or do you expense it, or does it just show up as an expenditure under governmental funds? Governmental funds follow what? Modified accrual basis, and therefore what do? It shows up as an expenditure. In the government-wide, what do? You capitalize it. If that was the only difference between those two statements, will you be able to reconcile them? Yes. What would you do? From the modified accrual basis, you just subtract $1 million and it will give you exactly the same result as the other. And this is what they do. And I'm going to show you this reconciliation on page 376. And I'll tell you what you need to concentrate on. This is just reconciliation of the balance sheet to governmental fund statement of net position. Just watch this for a moment, okay? What was the bottom line in the balance sheet? Fund balance was 281. What was the bottom line net position? 17 million. You say, and this is what drives people bananas. They say, you know, that could be nice to just see a little difference. How could you have two statements be so different? One showing what? 281,000 as your equity, and the other one showing what? 17,211,000. And this has been really, actually, there were a couple of people at Harvard University who wrote a working paper on why GASB was going nuts with the new financial reporting model. Because their contention was you have two operating statements or two statement of positions showing such different numbers. Which one is it? And this is the reconciliation. They start with 281, amounts that are reported which are different, capital assets. Why did we add it to 281? Because what would we do? We would expense it, right? We would subtract that. So now what do we have to do? We have to add it back. And these are the adjustments that go through it. I'm not going to ask you to do this exercise, but I expect you to know a couple of things. What makes modified accrual basis different from accrual basis? Capital assets, right? Issuance of debt, right? Depreciation, right? Those are the three principal things. There are others that show up, but basically it's capital assets and long-term liabilities, and you see accrued interest payable. So those are the three items. That's what I want you to know.
Can you repeat that?
Yes, the capital assets, the long-term debt, and accrued interest payable. Okay? Those are the three things which make the two statements different. Let's go down to the bottom part. And guess what? The bottom has the same thing except for we have the capital assets, we have the debt service, but then we have some other things. And let me explain this to you too. Under the operating statements, remember that question I asked you? What's the GASB rule on accrual of taxes? How many days? 60 days. What happens after 60 days? It goes into the next year, right? What about full accrual basis? No limit. So you could have different numbers for revenues under two different bases. And that's what that is adjusting for. Okay? Revenues and expenditures, I know this is kind of, I see people stretching, I see people just getting, but bear with me. You'll get this, okay? I'll make sure you get it before you leave, okay? Which is that you need to be able to the purpose of this exercise is to identify items which are different. And what are they? Capital assets, long-term debt, accrual of interest, recognition of revenues, and recognition of expenditures. That's what makes things different. Okay? Okay. Capital assets, long-term debt, accrual of interest, revenues that are shown differently under modified and full accrual basis, and I gave you an example, property taxes are one, and expenditures which show up differently under modified accrual basis as opposed to accrual basis. Okay? So those are the 5 things that come to mind. I'm not going to ask you to do such a reconciliation because I'll tell you, when I did this and I reviewed this, I would scratch my head half the time and try to figure out how I'm going to get this thing to balance. Okay? But it can, it's done. It's done by accountants. So by hopefully those who know what's going on. Okay. Couple of other things, and then we'll take a break. I think it's too warm in here. Right? Don't worry about this new recognition, and it's called the near-term measurement focus. Yeah, don't be concerned about it. This is something, a new developing field with GASB. And wait till I tell you. You thought accrual and modified accrual was worse? What if we have another basis, a near-term basis? Are you still going to take this class? Okay. All right. That's what this is, okay? Changing the modified accrual basis. And popular report. So how many pages was that CAFR report? Bless you. About 300 pages? Somebody had this bright idea. Said, you know what? This is crazy. We're going to issue something called a popular report. Summarize everything in 10 pages. The auditor said, sure, go ahead, summarize it. You're not getting an opinion from us. They said, doesn't matter. And many governments issue something called the popular report. And I was looking for, this is Virginia's popular report. They have nice pictures, nice charts. See, make it very easy. Look at this. Statement of net position, activities, no reconciliations, nothing whatsoever, just very straightforward. And they even got an award, 20 pages long. Okay? So they put charts and, just make things easy to read. All right? So that's the popular report. Now going back to one final topic here is the something called OCBOA, O-C-B-O-A. Now, after having taught you everything about GASB, about generally accepted accounting principles, and how they're applied all over the country, what if I were to tell you that New Jersey doesn't follow them? So if you're looking for a job in a New Jersey town, they say we don't care. New Jersey follows something called Other Comprehensive Basis of Accounting. Other Comprehensive Basis of Accounting, which very simply means not GAAP. No GAAP here. Why do they do that? Why does New Jersey and a few other states do that for their local governments?
Make it harder for governments to be solvent.
You know what? Absolutely. Excellent answer. Because many people feel that with GAAP, governmental GAAP as per GASB, you have leeway to do certain things. New Jersey has something called statutory basis of accounting. The accounting is written in law. This is how you are to do things. No leeway. Why? To do exactly what he just said, to prevent governments from going under. Very strict controls in New Jersey. As I said to you, it's one of the few states where the state can come over and take over the government and throw the mayor out and everybody else. So, and it has happened in this state. So we use something called the Other Comprehensive Basis of Accounting. And if you ever work in the audit area, for instance, with a big accounting firm or a small accounting firm, you will be auditing under OCBOA principles. Okay? Now, some of them, to make things make things really interesting, New Jersey towns follow OCBOA. New Jersey school districts, schools within the town, follow GASB. Okay? State follows what? GASB, GAAP as per GASB. So now you've got these people following different accounting standards. Okay? But that's what that is, and that's why I tell you this is that if you take a look at city's financial report, it's going to be very different. And it's interesting because, you know, I don't know if you read a couple of weeks ago, there was an article in the Economist magazine about the problems in China, where local municipalities had gone out and borrowed tons of money. And they were really in trouble because of all this. And one of the things is because they don't have the standards. And I'm sure they'll be looking at US and some of the other countries towards doing this to be able to do that. People are going crazy. In New Jersey, you cannot have that. There are strict rules as to what you can borrow, for instance. All right? So that's the OCBOA. Let's do one thing. I'm going to give you a series of questions. All right, first we'll take the easy one, which is on page 410. I didn't assign this question 9.8 to you, have I? I don't think so. Take a look at this statement. This is for governmental funds under modified accrual basis. Take a look at this statement for a quick moment and tell me if there's anything wrong with it. All right. Take a look at this. Let's start off with the title. Statement of Revenue, Expenses, and Changes in Fund Balance. Governmental funds. Anything wrong with that? Good. Other governmental funds. Anything that you would want to know? Are they major? Are they non-major? Remember that? Right? Remember that? Okay. Anything else missing? Don't you usually have a total at the end? Right? Okay. Let's take a look at the debt proceeds. Is that a revenue? That's called what? Other financing source. Anything else? Transfers in and out are usually shown separately below the line, right? Anything else? How about this, net change in fund balance? Should there be something else? Opening and closing fund balance. But in order to get that, you had to be familiar with looking at the statement itself. Okay? So those are some of the things that come to mind. By the way, one other thing, general government and debt service, do you combine those two? No, debt service is always shown separately. Okay, so we'll go through this next topic and then take a quick look at the homework, and that will be the class. Now, with all the topics you've gone through so far, this is where you really begin to use what you've learned so far, which is how do you analyze government financial performance. And we'll get a quick lesson here. Actually, in the program, in the master's program in governmental accounting, we have a whole course devoted to this one topic, an entire semester-wide course, because this is a really, really interesting area, especially in light of some of the bankruptcies and all the things that have been happening. Missing a few people. What happened to the class in the back? All right, clicker time. I thought it was because I couldn't see in the back, it was dark, but now when I... Oh, there are? Okay, good. No, clickers. Let's do that. It's like the back row is just gone. Everybody good? Everybody? All right. So we did lose 5 or 6 people. All right. Yes, I didn't think about that. Yeah. Okay. So going back to this, what we're going to be taking a look at is, I think we all know why we need to evaluate government financial performance, but we'll take a look at some definitions, and then we'll take a look at some of the ratios and how we use them. Did you do any ratio analysis in your accounting classes so far? Okay, we're going to use ratios from the government-wide statements and the fund financial statements to evaluate the performance. Okay, so why do we evaluate government financial performance? Again, you've heard of problems in Stockton and some of the other places, Detroit now, where there have been some serious problems with people, with municipalities going through fiscal stress. We call it early warning system of impending financial difficulty. What happens when a town, if you live in a town and it gets into trouble? Why are you concerned? Why? Because you're paying taxes, so what's happening? You're not going to get services, but then what else are you afraid of? Property taxes are going to go up. So that's your incentive, right? To make sure that so you just said two things. You said services, and you talked about your taxes going up, meaning financial position is being impacted somehow. You know what? We just took care of the definitions. And we'll go through what you just said are the three definitions, okay? Which we'll go through now. By the way, who are the folks who are most interested after the citizens? Creditors, right? And they do that through, and who acts on their behalf, or who monitors that on their behalf? The credit rating agencies, yep. So these are the people: government managers, bond investors, creditors, legislators, citizens, taxpayers, intermediaries. Now let me ask you this question. Your interest as a taxpayer and as a resident of the town, is that the same interest that a creditor has or a rating agency has?
No.
Why do you say that?
Because your interest is obviously one, they can raise taxes, so creditors don't mind if they raise taxes.
Yeah, that's right.
Services you receive, the way they spend their money is important to you versus the creditors that care how they spend their money.
Right. They would rather have government give no services and pay them, right? Right? But that is the important distinction. So even though they're all listed here, they all have different interests. Some of them might have different interests. So I want you to think about that. Citizens, taxpayers, creditors, bond investors, managers, they could have varying levels of interest in what they focus on. Now you've heard of the going concern, right? Concept. Now what we have here is that we want to make sure that the government can continue to provide the level of services that it should or it's presently doing, and whether its debt service, when it comes due, will be paid. These are the three important things then. We talked about two already. One was what? Provide services. Second was what? Service their obligations or debt. And what's the third one? Is in compliance with laws and regulations. Now that might seem like a fuzzy thing. You don't want a government to be breaking its own laws, right? Doing crazy things, okay? And that's why we talk about, and compliance with laws and regulations means compliance with their budgets that they have, okay? These are the three definitions that I want you to get it down, these definitions down. I will definitely ask you about this, okay? I know as soon as I said that, then financial position. Let's take a look at, this is short term. Financial position is what? Short term, okay? It's a short term concept. It focuses on assets, liabilities that require cash or are normally converted to cash on a short term basis. That's the meaning of the word financial position. I don't want you to interchangeably use these words. Don't use financial condition for financial position or financial position for financial condition. Now tell me, what is the difference, I keep on losing this thing, between financial position and financial condition. What's the difference between the two? What do you see the difference there? The difference you see is that in financial condition, you have what else? Service obligations. So it's not only meeting your obligations, but also doing what? Providing services, right? So that's in addition. And what's in the economic condition? That's GASB's term. It's a composite of the government's financial position and its ability to meet its financial obligation and service commitments. Very similar to financial condition, but this is GASB's term, which is the economic condition. If anyone is interested in this subject further, GASB has two guides out. One is a guide on interpreting government financial statements, and the second is how to assess a government's financial condition. In fact, the fellow who wrote these guides is on our faculty. And I say this because maybe years from now, if you ever got back into this, they are wonderful guides because they explain very simply. You don't really have to know a lot in governmental accounting, these concepts. How to interpret government financial statements and how to assess government financial position. So now we are going back to GASB's term, economic condition. Economic condition is divided into financial position, fiscal capacity, and service capacity. Financial position, we know what that is. Fiscal capacity is the ability and willingness to meet obligations as they come due, and service capacity is the ability to provide continued service. So it's pretty straightforward. It's, don't make it any more complicated. Now there is an entity called ICMA, International Cities Management Association, which has its own terms: cash solvency, budgetary solvency, long-run solvency, service level solvency. And just like GASB had those three things, ICMA has these following four things. Cash solvency, well, that's important to be able to meet your obligations to pay your bills. Budgetary, make sure that you have enough revenue to cover your budgets. Long run, can you keep on going on the long run the way you are? And obviously, can you continue to provide the services that you presently are? Okay. Now, there is a nice graph in the book, and make a note for it. It's illustration 10.1. Basically what it does is explains their ICMA has come up with something called a financial trend monitoring system. And let me see if I can get to that so I can just show you. It's a nice graphic. It's on page 419. Okay. This is their, looks like a lot of stuff, but what I want you to do is just take a look at okay, have a good factors affecting financial condition. What are the factors that affect financial condition under ICMA? Okay. And look at the factors: environmental factors, organizational factors, and financial factors. Environmental factors, organizational factors, and financial factors. These are what affects financial condition. Okay? And we're going to just go through that quickly. let's take a look at some of the factors, the environmental factors. I want you to take a look at this and think in your mind what each might mean to you. Community needs and resources. What kind of things does this tell you? Where the community is in terms of its income, population, age, employment, and it's very interesting because when you think about this, what comes to mind is the need for government services and the capacity to provide it is inversely related to what that community is. So the more, for instance, if you have a community which has socioeconomic factors which aren't that great, what is its need for services? And what is its capacity to provide it? Do you see do you see it? It's a very interesting fact that we see is that, communities like that, they have very high needs, but they have very low capacity to provide those needs. So, these are some of the things that come up. And intergovernmental constraints. What are intergovernmental constraints? Let me give you a quick example. In New Jersey, towns cannot raise their taxes by more than 2% each year. That was one of the things Governor Christie did. He said, you know what? You can't raise your taxes more than 2%. Okay. Disaster risk potential for, so if you live in a shore community, well, there is a disaster risk, right, that you're involved with. Political culture. Now, this is interesting. And I don't mean to really get into the politics of things, but let me ask you a question. If you're buying a home in a community which was the mayors and council and everyone was totally Republican, and then you had a community where the governing board and everyone else was Democratic. And now I'm not making any broad inferences, and please don't take it that way. But who would be more susceptible to not raising taxes? He's politically correct, because he said both, right? But if you look at the history, right, basically what you find is that depending on the political affiliation, some communities they don't want to do anything in terms of in any way raising taxes. Now, when you don't do that, what happens? Well, there are service cuts, right? And, people might respond and say, well, that will make them more efficient in the way they provide services. So that's what that means, political culture there, okay? External economic conditions, which is, it's not always what happens locally, it's also what happens nationally that might impact you. Organizational factors is basically how the management acts. There are managers who are very fiscally prudent. And how do you see this? You see this with, for example, how they fund pensions, whether they invest in capital assets, how do they go out, raise money, debt, for instance, things like that. This is very interesting because first we looked at the socio-economic, right? Now we're looking at management, right? And then finally we'll come to the financial factors. Most of us think that financial analysis is just what? Financial factors, but it's not, okay? So now we look at the organizational factors. And I said, what are some of the things? Organization, budget gimmicks, one-time fixes on the budget. This would be an organizational factor. Do people do that? Okay. Defraying maintenance, not fixing things till everything's finished. That's not an organizational factor. What you are doing now is what a credit analyst would be doing. This is what they would be looking at. The rating agency, they'll look at all these factors and they'll assign them. Unfortunately, many of them don't share this with the rest of the world because they're proprietary. They're proprietary models that they construct and put together. And this is ICMA's framework. And then financial factors. This makes more sense because you begin to see now revenues. Are they growing? Are they diverse? Expenditures, how much is it ongoing? Operating position, debt structure. We'll take a look at this more. But these are the financial factors. So basically, ICMA has those three types of factors, and within those you have all of these indicators that people look at. But we'll take a look at ratios, which is kind of fun. And I'll give you both the positives and the negatives. So when you do ratio analysis, where do you get the data from? Mostly from where? From the financial statements, right? And that's what we're going to do. Get the ratios from the financial statements, right? What are those financial statements? Fund financial statements and government-wide statements. We're going to get ratios from each one of those. Okay. And what this says is, and this is, by the way, the exercise I was telling you we're trying to do at Rutgers to be able to do this type of work, but do it automated, where the system automatically pulls all this data, compiles all the results, and all you get is the final results. So this is what we're trying to do here, which is to do it across the country and hopefully for all the public entities throughout the country. Now, the last part, examining multi-year trends in financial factor as well as those for 1 year. You've already studied in ratio analysis. Do you ever look at one point in time? No, you have to do what? Give it perspective by looking over several years. So for example, if your fund balance keeps on decreasing over a period of time, do you like to see that? No, that means what are you doing? You're using up your savings, right? What happens if your fund balance keeps on going up? Well, as a taxpayer, you'd be concerned. As a manager, you might say this is good, right? So we look at each one of these, and what you'll find out is that ratio analysis for governments is very, very simple because it's very intuitive. Without knowing, I'll ask you the question, you'll give me the right answer, okay? And we'll go through that. Am I being too optimistic? No. Okay. So this is where we get our data from. Government-wide statements, fund financial statements. We look at the notes, the introductory section, the statistical section, and any other publicly available source. There is an entity called MSRB, Municipal Securities Rulemaking Board, which is plays an important role in governments because of the rules it issues for government bonds. And they have a lot of information. And why I mention this is that if you ever wanted to get financial information on anybody, you just go to the MSRB and you'll be able to get it. Let's take a look at this. These are, now remember I said governmental funds and then the governmental wide statements. Let's take a look at the first ratio. These are revenue measures. Revenue per capita, operating revenues divided by population. Is this number better, higher, or lower? Yeah, right? What happens if it starts to go down? A concern, right? Operating revenues divided by population, right? So if your operating revenues fall, what happens to the ratio? It also drops. Okay, yes, it could be that, or industry leaving town, for instance, right? How about one-time revenues? Would you like to see a higher or a lower number there? What is it? Lower. We don't want one-time revenues. If you have one-time revenues, that tells you there is an issue. If 50% of your revenues come from one-time sources, you're in trouble, right? So as I talk about this, I want you to, in your mind, think about what's good and what's not good, because this is one of the exercises I gave you for the homework, okay? Let's go to the next one. Now we go from revenues to expenditures. A higher number under revenue was good. What do you think for expenditure? Is that good or bad? A higher expenditure per capita. It's not really good. If your expenditure per capita are increasing more than the rate of inflation, there's a problem unless you have something going on. Everybody understand the meaning of per capita, right? The word per capita is anytime you use population. Anytime you use population, it becomes per capita or per person, okay? This is what they are spending per person, expenditure per person. Employees per capita. Now this is an interesting question. Number of employees divided by population.
Well, it could be good.
It could be good if you're one of those, right? Okay, but mostly people don't want to see high number of municipal employees per population, right? Okay. Is everybody got that, right? So, okay. These are operating positions. So we looked at revenues, expenditures, and now operating surplus. Operating surplus. What do you think? In the first one, how would you evaluate that? Let's look at the surplus first. Don't assume the word deficit doesn't exist there. Operating surplus divided by operating revenues. What would you say to that? Well, what you want is some amount. You don't want a lot, because if you have a lot, that means what's happening? People are paying a lot of taxes, right? But what happens if it's a deficit? Do you want a deficit over operating revenues, a high operating deficit? No, definitely not. Fund balance. Now, this is a tricky question. And this is a question which everyone is faced with in government. What should your fund balance be? Now, I want you to think about fund balance as the rainy day fund here. Let's take the case of New Jersey or another state. Let's say your budget was, let's take New York City, $50 billion. And you're expecting revenues of $50 billion. Are you going to get exactly $50 billion? You know you're going to spend $50 billion, which you will probably. But how about raising that money? Should you build in a little fund balance in the event you get $49 billion only? Yes, you have to have something. A rainy day fund, right? The question is, how much of a rainy day fund? 2%? 5%? 10%? 1%? There are states like New Jersey which have less than 1%. And then there are other states which have healthy numbers. Question is, what should it be? Well, let me ask you, what do you think it should be? Your rainy day fund balance. This is your little savings account squirreled away in case you don't hit your revenues. What do you think? You said 5%. 10%. Now tell me one thing. Rather than just a number, can you give me a reason for why you said 5 or 10%? Yeah.
I said 1 because the federal government will always get your back like Sandy.
No, don't count on that. No, that was a natural disaster. Federal government didn't come to the aid of Detroit when they went under. Yeah. Somebody else said, yeah. Why do you say that?
Because I'm taking into consideration that it was more expensive than
Okay. Okay, that's one thing. Rising costs. But you know what? I wish I could tell you a number. There isn't any. But it's a problem because guess what's going to happen? If you don't have a rainy day fund, who's going to get hit? Taxpayers, and right away. So, as a government financial manager, that's your responsibility. Make sure you have enough of a rainy day fund, which is there in the event something happens. And now you're caught. The credit rating agencies are saying, keep more of the rainy day fund. The taxpayer is saying, no, don't do that. Use it so our taxes could be lower this year. But that's the issue. That's with fund balance. Liquidity is an interesting question. What does it say? Cash and short-term investments. Anybody remember what was the quick ratio again? Yeah, except the inventory. Okay, and this is similar to that, like the current ratio, where it's cash and short-term investments divided by current liabilities. Okay, tell me what would happen if this number is less than 1? We have a problem with solvency, right? Your cash and short-term is less than your current liabilities. See the problem? So it should not be less than 1. The question is, what should it be? Well, what you should have is normally, and this is from my experience, you should have enough cash to carry you over for the next 30 to 60 days. Always happen. 30 to 60 days, you should have enough cash to carry you over. Okay? But it shouldn't be less than 1. Long-term debt. Long-term debt as opposed to assessed valuation, or do you want a lot of debt? Some people love it. I don't like it, both professionally and personally. The best feeling, and this is now a personal comment, that a person can have, and believe me, I say this from experience, is to be debt-free. It's a wonderful freedom. Unfortunately, and again, this is not a commentary, just take it as a personal comment, our society does not promote that. But the best feeling in the world is to be debt-free. And this carries forward not only personally, but you see that with governments, almost 12 to 13% of the U.S. budget is used for interest paid. And that's today with low interest environment. 13% I read on interest payment, 27% on defense, 25% on everything else, and then 25% on health and education, something like that. So you can see how interest by itself is taking over 10%. So you don't want, obviously, that's what that is. Current liabilities divided by operating revenue. Interesting. This is requires you to think about this. Current liabilities, do you want them large or small? Small, right? So the question is, what should they be? So let's take a look at it. 12 months, right? 12 divided into 100 is approximately. So just let's say about 9% or so, right? 9%, right? So if you got a number here of 9%, that would mean what? You have 1 month of revenues, right? 1 month of liabilities, or 1 month of operating revenues which represent these liabilities. Basically, it's a cash flow question, which is, if you didn't have revenues coming in, how far can you go on? And as I said, again, it goes back to the 30 to 60 days. And most people would say, but I'm going to get the revenues all the time. Guess what happened at the shore communities with Hurricane Sandy? It wasn't just things closed down, but something else happened, which nobody thought would happen here. When those buildings got washed away, guess what the taxpayers did? Those people who owned those buildings. They went back to the town and said, you know what? We're paying taxes on land and building. Guess what? Building's not there anymore. We're not paying you taxes for building which was supposed to be there. All of a sudden, the town, which knew buildings could never move, now had what? Only land that they could tax, and there was no property. So not only did they suffer all this damage, what else happened? These taxpayers came in and said, sorry, there's no building. Can't pay you taxes on something which doesn't exist. And the towns, therefore, had to absorb that. And that's the reason why I mentioned that to you. Okay. Unfunded pension liabilities, I think we talked about that. You definitely, this is one of the biggest things. This is your net pension obligation. Okay. You don't want it to be increasing. You want to decrease or have it the same. Decrease is better. And the same thing is here with the liability for post-employment benefits. Capital outlays from operating fund. And this is an interesting question. A lot of towns and others don't want to spend money on capital until things are totally done and finished. They don't want to spend money on maintenance, which is sad. And why I say this is, most of you would say the less capital outlay, the better. I would argue against it. You should have a certain amount of your budget for capital items. Why? Because if you had it, you would keep the things in shape. If you didn't, you would replace equipment. You would do things like that. So this does not necessarily mean that by spending too much money on capital, it's a bad thing. You should spend a certain amount on capital items. Now, these are the government-wide measures. We moved from fund to government-wide, and these are relatively straightforward because we talked a lot about these. Unrestricted net position, not restricted in capital assets, or restricted, unrestricted. That's our rainy day fund. Capital asset condition, how does it look? Pension plan funding. Will we be able to pay our employees when they retire? Look at Detroit. Debt to assets. Who really owns the governmental entity? And quick ratio, which is our short-term cash position. And these are some more. We'll just go through a couple more. Changes in net position. Did it improve, decline, or remain steady? Now, what I want you to do is, I know we looked at these all at point in time, but think about doing this analysis over many years, over past 5, 6 years. You need to establish a trend. You need to know, is it isolated or is it a trend? If it's a trend, then you know there's something that's serious, that's worth looking at. Interperiod equity. Remember interperiod equity? Who paid for the cost of operating the city? current, past, or future tax and rate payers. And this is a thing I can spend hours on, this and what we have done, a total financial disaster at the federal level. Not just an ordinary disaster, an unbelievable disaster as far as interperiod equity goes. It's the guys who will come later, they'll take care of it. Because Congress cannot agree. And because of that, this whole issue of interperiod equity. Business type, I think this was one of the exercises. If it's business type, does it cover its expenses? Or do they get subsidy from elsewhere? Well, if it's business type, it should cover, unless it's a public transportation system, such as New Jersey Transit. Okay? Debt service coverage. Okay? Were our revenue bond invest with our ability to pay them on time? Obviously, they would be. These are financial capability ratios from financial performance ratios. Revenue dispersion. This is one-time revenue as opposed to what the other revenues are. I'll give you a quick example here. You're ready to go buy a house. And you look at two towns. One town has 90% of it is residential. The other town has 50% residential, 50% commercial. They're both the same every other way. Which one would you think of? Why did you say commercial, by the way? The question is this. So I have two towns, right? They're equal in every way, and you're ready to buy a house. So one town has 90% of the town is all residential. The other town is 50% commercial and 50% residential. Which one would you pick, and why? Yeah. Why do you say commercial? Because he said commercial. Okay. So because you feel that the commercial property, because commercial property owners don't send kids to schools, right? Right? Is that one of the things? Because unlike residential, commercial property owners don't have kids who are going to the school, right? So you save money that way. And you know what? Most people would answer it that way. But, we don't have time, but it is a double-edged sword, and someday I'll tell you about that. But most people would do what you just said, and that's why towns go crazy trying to attract commercial development, because they don't have to be, people work from 5 days a week and they're gone. Services, not like residential. Schools, nothing like it. And yet they pay what? Exactly the same tax. So that's one of the reasons. Debt service load, okay, what part of our budget goes to paying off long-term debt? That's obvious. What is our long-term general obligation debt burden on our taxpayers? And will we be able to issue more long-term general which is the legal debt limit? And even here, it's amazing what people do. I'll give you an example. A town reaches its debt limit, can't issue anything more. You got to do something. Example, right from New Jersey. I won't name the town. Hire a very clever accountant, CPA, and a very clever lawyer. And they say, you know what we're going to do? See this water department we have? You do all we're going to spin it off as a utility. It will become what? A business type activity. And because it's a business type activity, it's a separate entity, legal entity, they'll go out and borrow money. Happens all the time. Or better still, a case where let's sell our waterworks to a private utility, to a for-profit entity, and use that money to lower our debt. Well, you know that the rate that's going to be charged by the for-profit entity is not going to be lower than the rate that you're currently being charged. But these are the creative things that happen. People think of all these things and how all to address these questions. Property taxes per capita, what is our property tax burden? And you'll see lots of statistics on this in New Jersey and other places. Benchmarking. Now I have to tell you, benchmarking is very popular among for-profit entities. Okay, but this is how it's received in governments. If you go to a government and tell them, look, your numbers don't look as good as this one. You know what their answer would be? We are different. We are unique. There's no one like us in the country. You can't compare us. 90% of the time. All governments like to be considered unique. And that's why when we talk about benchmarking against average data for similar governments, it becomes a very difficult task because people don't really accept that. But still, the analysis is carried out. And these are the credit analyst models. I spoke about this briefly before. Moody's and S&P have their own models which evaluate a government financial condition. And these are the factors that they use: debt, finances, debt, legal security, economic, demographic, and management strategies. No different than really the ICMA model that we looked at. And on the second floor, I don't know if any one of you have noticed this. Is it the second floor or the third floor? There's a Bloomberg machine. Do you ever notice that? Bloomberg terminal? Anyone use it? Anyone use it? Okay. On that, there is in my previous life, I used to be an investor in fixed income securities. In it is a key for municipal bonds. It has a wealth of information because not only would it give you government bond pricing, but a lot of information that we talked about. Some of the summarized CAFR and some of it, but it's Bloomberg. Bloomberg is, as you know, is not a cheap thing. At school, do you know what that costs if you are not here? The Bloomberg terminal? It's $2,500 a month to rent that terminal. So it's not, but when you're doing trades which amount to millions of dollars, just the pricing differential, if you're not right, one single trade would just pay for that machine for a couple of months. So, but my suggestion to you is, and not to digress, okay, is that as an accountant, you should really try to expand your knowledge into finances, into government finance or into corporate finance. And one way to do it is by, for instance, the Bloomberg, they have all the markets. Bloomberg has a certification program where you can go in and take their online classes and be certified to use the Bloomberg. So if you ever had to, over a summer or wherever, work in an environment where you're required to work on Bloomberg itself. So it's really a wonderful thing, and you need to really broaden your horizon as far as accounting goes. Okay, so we talked about rating. Let's take a look at some of the fiscal stresses. What are some of the fiscal stresses? Decline in revenues relative to expenditures. We know that. Declining property value, declining economic activity, capital plant going downhill, increasing unfunded obligations, and inadequate capital expenditures. These questions, as you look at these questions, think about whether the CAFR answers these questions. And some of them it does, but some of them it doesn't. And the reason why I tell you this is, many years ago, Governmental Accounting Standards Board suggested, remember those service things, the economic condition definition. It says ability to continually provide services. In the CAFR, do you see any service information? No. So somebody said, wait a minute, this CAFR is half complete. You're only talking about money being spent. What is being accomplished? So GASB started this project called Service Efforts and Accomplishment, where they wanted to build into the CAFR information on outputs and outcomes, inputs, all of that, so people can see what they're getting in return. Well, when they did that, there was such an uproar from all the municipalities, the CFOs. In fact, they got so mad at the GASB that they all passed resolutions and sent letters to Congress saying, get rid of GASB. I'm not kidding you. The GFOA, Government Finance Officers Association, which is the largest organization in the country, said it's time for GASB to disappear. Why? Because GASB was pushing to include non-financial data which measured the effectiveness of governments. Do you see the problem? That's why we need some young, intelligent people in government to straighten things out, because this is what we're faced with. Now, fortunately, at the federal level, not at the state level, there is, if you go back all the way to Chapter 1, there's something called Performance Accountability Report, which measures some of this. So at the federal level, you see it. But at the state and local level, nothing. Why? Because we are unique. We do things the way we do, which nobody else does. Okay? But I wanted to mention that to you because it's this resistance on the part of governments to measure things that are non-financial. All right, let's take a look at our homework assignments. Actually, first, let's take a look at a couple of questions. And okay.